bring in a voice on the economy. There's plenty happening on the economic front. You have the rupee, you have IIP numbers which are weak, you have GDP numbers which are strong. Let's wrap all of that together and get a perspective. Upasana Chachra, Chief India Economist, Morgan Stanley, joining us this morning. Hi, good morning, Upasana. This is Harsh here. Upasana, let me start off by first getting your perspective on the rupee, because of course the other parts are also equally important, but the rupee continues to slip, and we've hit record lows. Talk to us about what you sense is the reason for the pressure. Is it FII selling? Are there other factors involved with regard to what's happening to the rupee? And should the RBI come in and intervene, or holding back is the right approach?
Hi, good morning. So on the rupee, yes, rupee has been on a weak footing almost all through the year. It is one of the worst performing currencies in the Asia or the EM pack, if we were to see. And even on a real effective exchange rate basis, the rupee is undervalued now, having fallen more than 7-8% on a YTD basis, on a RER basis. What is impacting rupee, I think, is mostly to do with the capital account and the capital flows that have been very weak for most part of this year. We have seen relentless FI outflows not only last year but also continuing into this year. At the same time, the net FDI numbers have been weak as well, driven by higher repatriations that we are seeing. Again, that story has continued into this year as well. So while the current account deficit at the margin is wider but not really in a big danger zone, the capital account has been a problem in the last few months, and that is also evident when with the data that we got yesterday for the September quarter. The current account deficit widened, but not like massively. It's at 1.3% of GDP. We call the comfort range for CAD in our minds is usually 2 to 2.5% of GDP. But against that 1.3% of GDP, we see that the BOP was in deficit because the capital account was just very minor surplus at just above $500 million. So that is the story, that capital flows are not adequate to fund a fundamental side, the pressure on the rupee. Of course, added to this is the uncertainty with the delay in the India-US trade negotiations and trade talks, which is, of course, adding another layer of a negative sentiment with respect to the external accounts and the external dynamics. Having said that, we think that rupee moderate pace of depreciation is something which will help the overall export competitiveness, especially from context of the right now higher tariffs that India is facing with the US as well. But the pace of depreciation has to be managed, and that is what I think the RBI has been trying to do by trying to reduce the volatility in the movements of the rupee.
Right. And Upasana, what's the sense about how to read into the macro data of late? Well, of course, the GDP numbers were impressive. I can't say the same about the IIP numbers. Although there is that, I guess, Diwali effect also, which is into play. And, typically because workers go back home and take time off during this period, production is traditionally lower.
Yes, you're right. So, real GDP growth was at a three-quarter high at 8.2%, higher than all expectations, including ours. And the breakup of the data shows that manufacturing was growing even above that level at above 9%, and services also remained very resilient. So, in terms of the supply side dynamics, it portrays and exhibits a pretty solid growth and an economy that was in the September quarter. If we were to look at, however, certain other high frequency data points, you would see that the trend is more mixed for September quarter. There are signs of pickup, but probably the strength that we feel and see from the 8% real GDP growth probably is difficult to reconcile with some of the other high frequency data points. And over there, I think the whole angle with the nominal growth comes in. That nominal growth was actually a tad lower versus June quarter, and it actually slipped to a 4-quarter low. And the gap between the real and nominal GDP was at, I think, a 6-year low in terms of how they are now because of the low deflator. So I think there is a problem of lowflation, which is impacting how corporate revenue and corporate earnings have also behaved in the last few quarters. From a high frequency data that we are seeing right now, and you make the point of IIP. IIP growth in October was weak at 0.4%, but you're right to point out there is a lot of seasonality in this data point because most of the festivals were in the month of October this year versus last year where they were more spread out between both October and November. So we were just looking at, the number of working days, and we at least have lost 2 working days in October. And if you were to just, just add those 2 working days, and that could add growth of about 6% odd to the IIP number. So that's a very seasonal aspect. I think it would be better to look at October and November on an average basis when we get the November data to assess the final growth or the underlying growth momentum from a high frequency basis.
So, Upasana, what I gather is no concerns at all from that IIP number that at least you seem to be penciling in, right?
Yes, I don't think we should look into the October number and get very concerned because you already, I think, have seen certain other high frequency data points for October as well, like the festive season sales, the auto sales number, even for November, which have held up, PMIs, which have been broadly okay and in range, bank credit growth, which is picking up. So I don't think IIP per se can be seen as a very worrisome or concerning indicator because we should look at all indicators in conjunction. And most indicators point to the economy gradually recovering.
Upasana, what should one make of the GDP number, 8.2%? And do you expect this to hold up? And second, what could the impact of that be on policy? Because you'll have the RBI policy come through later this week.
Right. So, as I mentioned earlier, the 8.2 number was definitely higher than consensus and our expectations. We were at 7.1, consensus at 7.3. So there is a meaningful beat in terms of the upside surprise that we saw in the data point. We do expect, some of these dynamics, which are basically a low inflation environment, keeping deflator low, to persist in the December quarter as well. So the deflator impact will probably keep the real GDP numbers still high. We are penciling in a number around 7.7% right now for the December quarter. We'll obviously be looking at how high frequency data also pans out, but I think the deflator impact will mean that you'll still see a pretty solid number for the December quarter. The headwinds to growth, though, in the second half would be that the base effect starts normalizing. So the first half had a very low base from last year, and that was impacting the YOY numbers, but that will now gradually fade. And the public capex spending momentum, which was very front loaded in this year, will also start fading. Not only just because of the front loaded spending, but also to the extent that revenues have been subpar. There is going to be some amount of pressure on the government, in our view, to manage government spending at a level lower than budgeted to ensure that they meet the fiscal deficit target. So public spending contribution would be also weaker in the second half. And on the external demand side as well, there has been an impact of front-loaded exports to the US in the first half, which will also start normalizing. So these are the headwinds. On the tailwind side, I think definitely on the consumption side, because of the monetary and fiscal policy support, the strength in rural demand, incoming data for winter crop sowing also looks pretty good. So the strength in rural will continue. And we are seeing some green shoots on private capex side, which should also hopefully continue, and on the household capex recovery as well, which is now coming. So I think the contribution of growth may shift from public capex, external demand or exports, adding to that fillip in the first half towards consumption. But overall growth numbers will probably still be pretty solid, especially for the December quarter. Before I conclude, I think we have to keep in mind that we'll have a new GDP series in Feb as well. So we'll, have a whole new set of data points to assess at that time.
That we sure would be. But Upasana, from the market's perspective, it's the RBI policy outcome that one is anticipating. And then, of course, the Fed. What is it that you're watching out from these two events? And where do you think the Fed and the MPC will move?
For the RBI, our view has been that there is room for RBI to ease, primarily driven by the benign inflation trajectory. We do see inflation remaining below what RBI is anticipating. Our number for fiscal 26 is at 2.2 with a downward bias. Even for next year, we see inflation around 4 or a little averaging a little below 4%. So, in that context, we do see that RBI has room to ease rates. However, I'll acknowledge it's a close call, given that the inflation story is something that was that's known or applicable even in the October policy. Since then, the new data on GDP growth has been higher than what RBI was penciling in at 7%, and therefore it does become a close call. But I think if RBI looks at nominal growth environment and the problem of lowflation, I think then the call should be that there is room to ease, and probably the window to ease is also more appropriate right now. As we go into next year, we will obviously have some pickup in inflation, even though not a big massive one. On the Fed, our view is that the Fed is on pause this time, but we do expect the Fed to start from early next year, as we expect some of the incoming data points that will come on the labor market side will be softer.
Okay. All right, Upasana, thanks so much for coming in and speaking with us, giving us that perspective in this very critical week. Plenty happening on the economic front.